The property game is rigged. Let's have a look. Hello everyone, Florian.heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's look at this article from ABC News, just discussing or addressing the question why stocks and housing are booming while we're in recession and wages and savings are stagnating. Well, technically I'd say savings are going backwards because with interest rates so low and CPI a little bit higher, your money's losing its value. So let's check this article out. So Donald Trump has been right all along. The system really has been rigged. As the US election pantomime played out last week, and it seems to be continuing now, beamed into 1 billion lounge rooms across the globe, the real power play moved on in earnest behind closed doors. While votes were tallied in booths across the states and territories, America's central bank, the US Federal Reserve, began the arduous task of counting out billions more greenbacks to pump into the economy. Across the Atlantic, a similar meeting was underway in Threeneedle Street, London, home of the Bank of England. And a few days earlier, the Reserve Bank made a historic decision at its Martin Place headquarters in Sydney. Their aim? To insulate the developed world's biggest economies from the forces of the free market and ensure that wherever dangers are lurking in the real economy, there will be minimal impact on the prices of stocks, bonds, and of course, real estate. The game really is rigged, isn't it? You know, can we bet against the banks? Can you bet against the Reserve Bank? Can you bet against the Cantillon effect? Rain, hail, or shine, the financial markets and property boom must go on. Can it last forever? The prospect of political gridlock in Washington, a nice guy in the White House prevented from achieving anything meaningful by a potentially hostile Senate, had Wall Street in ecstasy. The idea of a steady hand prevented from doing anything meaningful saw stocks and bonds bid higher by frenzied traders in one of the best performing weeks of this year. All this as a resurgent pandemic saw near global cases hit a record on Friday with a sharp spike in American hospitalizations. It coincided with tightened UK lockdowns that once again are threatening to send the economy into reverse, with an expected 11% contraction this year. So how to rig the market and not go to jail? On Thursday night, Jerome Powell and his fellow Federal Reserve Board members decided to keep American interest rates on hold. Given they already sit at zero, that didn't really come as a surprise. And as expected, it proclaimed that it would continue its quantitative easing program, upping the amount of cash it would pump into the system to $120 billion a month. The Bank of England's Andrew Bailey, in his very own whatever it takes moment, threw in another £150 billion. Once considered radical and experimental, quantitative easing has become de rigueur these days. Well, yeah, everyone is doing it. Everyone is doing it. Now, our own Reserve Bank governor said, you know, well, $100 billion for that, bond purchases, but then to meet our targets, we'll spend as much as we need. So everybody's doing it. Even our very own Reserve Bank, which dipped its toes in the water in April, but took the plunge big time last Tuesday, pledged to spend $100 billion over the next 6 months. In less polite circles, it's called money printing. So are we less polite circles here on YouTube? We probably are. You know, we probably are. You know, more. I'd say rather than less polite, I'd say more authentic. Yeah, more authentic. That's nice. Originally, the idea was that lower rates would encourage firms to borrow and invest, which would then lead to more jobs and an economic recovery. Well, rates are so low and money printing is going on, why wouldn't you just borrow and then buy bonds and write it up? Why would you invest in anything real? Why in Australia, with property doing so well compared to other parts of the economy, why would you bother dealing with the red tape, the staff, the logistics, the local councils to start a business? When you just buy a property, just, you know, make more than a yearly wage just in its capital gains sometimes. It's nuts. Oh, and you can write off all the costs and negative gear it against your other job. Why not? Less risk in some ways. Some does trickle down into the real economy, but mostly it's all about rigging markets, and it works like this. Central banks create their own cash and then wade into money markets to snap up the IOUs or bonds their government have issued to finance their deficit and debt. The huge extra demand drives bond prices higher and bond yields interest rates down. Lower interest rates make stocks more attractive. They also depress your currency, more on that later, because foreign investors scour the globe in search of the highest government bond yield they can find, and low rates keep house prices buoyant. So in one simple swoop, you can pump up asset markets across your economy, weaken your currency, which makes you more competitive. Sure, debt levels go crazy, but hey, it's all about today. Feels like it, doesn't it? Really does. The problem is that having laid the foundations for stock, bonds, and house price bubbles, the world's central banks are now scared witless about them bursting. And so on they go, adding ever more fuel to the fire. So central bank splurge. This graph gives you an idea of the extent to which central banks have gone over the past decade to ensure real estate and investment portfolios not just stay afloat, but forever head north. There you go, the Bank of Japan, Federal Reserve, Bank of England, the Swiss National Bank, the European Central Bank. I mean, there you go. Look at that. Look, just from 1999, 2 trillion to 24 trillion, all of them combined. From 99, everyone. That's not that long ago. That's 20 years ago. That's when I graduated high school. I'm from the class of 99. Or am I getting that old? Just nuts. It has been terrific for anyone with assets. For those trying to save to buy assets, it hasn't been such a great time. Wages growth has been anemic, and there's no point sticking your savings in the bank. Not surprisingly, the wealth divide grew into a chasm and now a canyon. The little blip in 2009 during the depths of the GFC looked far more dramatic at the time and had huge numbers of analysts concerned about how this could ever be unwound. Oh wait, yeah. There you go. Look at that. Look at that. Look at that roar. How insane they went. You know, from 4 trillion to nearly 8 trillion. They've nearly doubled. And now we're at 24 trillion. Look at this. Look at that. Looking at this, you can see why people are going to precious metals, why people are going to crypto, because this is just insane. Just insane. How on earth could the major central banks ever sell all that government debt back into the market without creating mayhem? There's the question. It's impossible. They can't do it. The answer, even from experts, largely was dunno, or maybe they'll just write it off. These are our leaders, everyone. These are the people that can dramatically change the value of the money in your hands. And then now they want to roll out central bank digital currencies. Could you imagine how much power they can have and how much control they can have? This really is, you know, we're looking at a dystopian future where it won't be big corporations controlling the world. It won't be evil governments. It will be unelected bureaucrats in, you know, in international organizations and world banks. Maybe I'm putting my tin hat on, or what do you think? It seems like it. What's scary? I think I'd rather have evil corporate overlords than this. Maybe I just need to play Cyberpunk when it comes out. So, since then it's quadrupled to 24 trillion. And with interest rates at 0, it has become the weapon of choice in controlling the economy. Now, no one bothers to even ask that question. And as for the potential market fallout, should the tap ever be turned off, or even down, let's not go there. My currency is weaker than yours. Not so long ago, politicians used to boast about the strength of their currency. Back in the 70s and right through until the early 90s, a weak currency could inflict near-fatal wounds on a government. It was considered a global assessment of a country's economic health, and it is easy to imagine Donald Trump boasting about the strength of the almighty greenback. There were times the RBA would buy Australian dollars using its foreign currency reserves to support the currency when it was under attack. Not anymore. Since the turn of the century, almost every major trading nation has attempted to massage or even muscle its currency lower in an effort to gain a trading advantage. A weaker currency makes exports cheaper and imports more expensive. It builds a protective wall around your domestic industry and makes your exporters rich. Rather than sell their currency as they did in the early days, central banks now use quantitative easing to manipulate central currency markets. They snap up their government bonds in the money markets. We've shunned the practice until now, and it has cost us dearly. As the resources boom kicked into full swing during the noughties, the Australian dollar soared within a whisker of US dollar at $1.10. I remember that. That was great. Loved it. We just bought we put a Kickstarter type of thing down for a laser cutter, and then the project fell apart, so I made profit on that. The economic purists down at the RBA argued at the time that the strong currency was a way of distributing the benefits of the resources boom to the ordinary Australians. Everyone could afford to buy what was once prohibitively expensive imported goods. In any case, they argued, we were too small a nation to try and fight a currency war. They were right. But their inaction decimated our industries, many of which were forced to shift offshore or simply shut down. Workers were displaced, particularly on the East Coast, as the economy was hollowed out. Last Tuesday, the RBA finally pulled on the boots and ran into a heavily tilted field. They'll be buying government bonds within a 5 to 10 year maturity specifically to weaken the Aussie dollar. The game may be rigged, but if everyone is doing it and you're sitting on the sidelines, you've got no chance of winning. And if it all blows up, everyone will lose. There you go. An interesting analysis by Ian here from the ABC. What do you all think, everyone? What do you reckon? We'll have to see. Do you think the bubble is ever going to pop in property? They're rigging the game. They're doing everything they can. We've seen it now. They've just extended JobKeeper. We've got mortgage holidays extended. You've got trading while insolvent, everyone. Trading while insolvent. One of the fundamental things of having a deal, doing business with a company, you have that element of security that they have to abide by these company rules, regulations, and pile of paper this thick and report to the ASIC every year. Doesn't matter anymore. What else are they going to do? Everyone. It's nuts. There's no political will to allow the free market to act here in Australia. I think down the path it could be a very terrifying future. What do you think? We need to get more people politically active, more of an appreciation of what is happening and how they're manipulating our lives on a fundamental basis. Anyway, guys, let me know your thoughts and opinions in the comments down below. Like, share, and subscribe to the channel. If you're a fan and want to support the content I create, there are a few ways you can. You can join us on YouTube or Patreon. Support us using our affiliate links you find down below. Buy a merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day. I'll see you next time.